Hello and welcome to 7 Minute Alpha. I'm Renee Kaesler, and today I'm joined by client portfolio manager Kevin Osten, who's based in GQG's Abu Dhabi office with myself. Kevin, great to see you.
It's good to be with you today, Renee.
So, Kevin, when I asked you what you would like to speak about today, I had thought you might want to discuss some of the groundbreaking IPOs or the hot topic that is Korean memory stocks, but you said no. I want to discuss the hottest topic of all, inflation and interest rates. So, with that in mind, let's get straight to it. Help a girl out. What is happening with inflation? Why is it so high?
So, Renee, first let's revisit some of the technical aspects with respect to inflation. From an academic perspective, monetary theory holds that inflation is tied closely to money supply. We don't have enough time to get into the nuances of money supply here, but let's think about it like a balloon. Central banks will inject money, air into the balloon and inflate it. That helps the economy grow, or they will take money out, deflate that balloon, and that will slow the economy down. So the idea here is to get that balloon to the right inflation where it's helping economic growth, but it's not driving inflation too high.
And then how does that work in reality?
So central banks have a couple of different tools at their disposal. The first being short-term interest rates, raising and lowering. They also use what's sort of known as bank reserves, although that's not used so much in the US anymore. But then they also have this fantastic magic trick, tool that central banks use known as quantitative easing. And that is literally making money out of thin air.
Which sounds incredibly dangerous.
I think many people would agree with that. But remember, this is usually in response or has been in response to crisis situations. So over the COVID-19 period, the Fed massively increased its balance sheet using quantitative easing to the tune of $9 trillion, which was 35% of GDP at the time. So to put that number in perspective, from the 1970s, when the US went off the gold standard to the great financial crisis, it had kind of hovered around a 4 to 6% range and closely matched the amount of currency that was in the system. So that $9 trillion, our poor little balloon has been inflated way beyond what I think anybody thought it could hold. But it has come back down from that 2022 peak a little bit. So we're now sort of a little less than 7 trillion at 21% of GDP, but that's still very high by historic standards.
And is there anything else that's impacting inflation?
Yeah, so there's some more concrete factors that are a little more intuitive that we can talk about. The first being sort of demand pull or excess demand from a strong economy, simple economics 101, that drives prices higher. Think about all the CapEx spending that's going on in the economy now for the artificial intelligence data center build out. You have that driving demand for everything from semiconductors to electrical supplies to electricity, and that's pushing up prices. Case in point, Tim Cook, the CEO of Apple, just came out last week and said, the prices of iPhones are going up because memory prices have skyrocketed. DRAM, the basic sort of type of memory that goes in computers, is up 200 to 300% over the course of the last year. So that's the demand side of things. You also have some shocks to the supply chain. So you've had the COVID-19 lockdowns, the disruption from that. Then you've had the Ukraine war. Then you had the Trump tariffs and immigration policy changes. And to top it all off, you've had the Strait of Hormuz closed, which caused a massive shock in energy prices. Energy is pretty much a basic input to everything. And so that's been pushing up prices on the supply side. Supply push is what they refer to that as. And so these types of things are somewhat hard to predict, or very hard to predict, I should say. Wars, erratic politicians, pandemics. And so I think that's one of the reasons that inflation has been stickier than what economists had expected and predicted, because it's so hard to forecast these types of things. Our friends at Goldman Sachs in December, they had a forecast coming that inflation would subside and go down over the course of 2026. Obviously, that hasn't been the case. But they weren't alone in that. The Board of Governors of the Fed in the US pretty much unanimously had inflation subsiding over the course of this year.
Okay, so we know what's causing inflation. What is the Fed doing about it? What can the Fed do about it?
So the Fed has a pretty difficult task here in the US. They have what's known, and they're assigned by Congress to have this dual mandate. The first part of that being price stability, which is a fancy word for controlling inflation. That's where that 2% target that they always talks about comes into play. And then, the other side of the equation is maximum employment, or said another way, low unemployment. They don't really have a specific target for that, but economists have kind of arrived at, let's call it a 4 to 6% range of the natural state of unemployment in the US. Think about it like maybe like a Goldilocks scenario, right? They don't know what the right temperature is, but they know when it's too hot and they know when it's too cold.
And is it too hot or too cold now then?
So let's look at some of the data there. The last data point that we have for inflation, measured by CPI, is 4.2% annualized rate. That's more than double that 2% target that the Fed is looking for. And it's been over that 2% target for more than 5 years. So that seems more like a chronic issue than a transitory one, and economists have been predicting it to be more transitory.
And so what else can the Fed do?
So remember that toolbox that I talked about? The most common thing that the Fed uses is short-term interest rates, raising and lowering short-term interest rates. But that's a very blunt instrument. It's kind of like using an axe for vascular surgery. There can be a long lag between the time they change rates to when it influences the economy. And they don't always get that right. They're trying to get out ahead of it. But think back to the post-COVID period, 2021, 2022, where all of that stimulus, that quantitative easing was put into the system. They were a little late pulling out that stimulus, and inflation skyrocketed, and they were late to reining it back in. So let's look at where we are now in terms of the data. So we've had these two wars, one on again, off again. We've had that spike in energy prices. We still have some of those tariffs around. We have $741 billion of hyperscaler CapEx that's expected for this year. And then let's not forget about that $7 trillion of stimulus that's still in the system. All of those things, suggesting pricing is going up. And then you have unemployment. Oh, by the way, it's at 4.3%, which is kind of right in the line with the notion of maximum employment.
So if all the data is suggesting that inflation is going up, surely that means that interest rates will also come up?
I mean, I would tend to agree with that statement, but recently the Fed's bias has been to lower interest rates. So think of it kind of like a weather forecast, right? If I forecast that it's going to rain and you, Renee, go and carry your umbrella with you all day, you might be a little miffed if it's clear and it doesn't rain at all. But if I make a weather forecast that says it's going to be perfectly clear and sunny all day, but then it ends up pouring all day, you're going to be very upset and I'm going to be in a lot of trouble. And so think about from the Fed's perspective, if they raise interest rate, it slows the economy down too much and it raises unemployment, they're going to get a lot more criticized than if they were just to let inflation be a little bit higher than it should be. So here at GQG, we don't try to predict rates. We're not any better than the Fed or anybody else, but we want our portfolios to be prepared for any scenario.
Excellent. And I was going to ask you about markets, but we have run out of time, so I'll have to ask you that next time. Thank you, Kevin, and thank you for everyone for attending.
I look forward to it. Thank you, Renee.
Thank you. Bye.